Welcome back, everybody. Today we are jumping into our week 2 portfolio review, and as you can see, the market had another brutal week. It was terrible for retail, and let me highlight that here. So in the last 5 days, the last week, retail was down 9%. This is a retail ETF, and on the backs of Target and Walmart earnings. And as you can see, Target was down 30% today. This is their biggest drop, like single day drop here since 1987. They were down 25% in one day, which is amazing. And even Walmart is down 20% in the last 5 days. And both of them cited that they have huge inventory, like size increasing, and like their net income were also obliterated because of stuff like fuel and labor compared to last year. And so this is not a good look for retail, because retail, a lot of people think, is like the first sign that we're going to recession. If retailers are struggling, that means the consumer is struggling. And so a lot of people think we're going into a recession. And after seeing this retail earnings report week, I definitely think we're heading in that direction. But so let's jump into the portfolio. So in the last week, we are down 2.68%, $320, and comparing that to the S&P 500, which is down 2.78. Again, we beat it just a little bit. That's what we hope to see. We hope to see in the short term beating it, but also in the long term. So yeah, so let's jump into the holdings. So like I said, the whole portfolio was down to almost 2.7%. Let's call it that. So let's look at Lockheed Martin. So Lockheed Martin was down 2.56%. I feel like this company is a hold right now. I bought it back. Let me go back here. Down right when this had this huge drop around $330. I sold it right around $460, and then been holding about 2 shares, just seeing where they go, because I think it's an amazing company, and I definitely want to be a shareholder for the long term. But right now, these prices, I feel like you can get a better discount. You got to wait for it to drop drastically like what it did here for me to pick up some shares at least. And then, so that was Lockheed Martin. And Waste Management, I've been doing a lot more research in Waste Management, and I just think I'll get into business models here with some of the stocks that I bought this week. But I mean, waste is not going anywhere. If we're going into recession, people are never gonna not produce like trash. The I know, like, the more the economy makes, the more trash it produces. So it's kind of tied to the economy, but in the long term, like, trash is gonna be here forever. And so this business model of just collecting trash and running landfills is amazing. And as you can see, it's just nice consistency going up. I absolutely love the company. They pay a great dividend. But right now the price is a little bit higher, especially with the market volatility. There's better buys out there, but I love this company. I really hope to pick up some more shares here soon. And then DGRO, we don't really need to cover. That's just an ETF holding dividend growth ETF. That's just holding like Apple, Microsoft, and like Pfizer. Don't really need to go over that. Apple, in the last week, was down 5%. I can't believe this company was almost below 130, which is amazing to me. This is, if I were to rank, like, this is a top 3 company in the world. They have one of the biggest moats. Even Warren Buffett here was buying it back when it dipped to 150, and it's just amazing to me that one of the best companies in the world is being thrown out with the rest of the market. And then like I said, I feel like there's better opportunities in the market. But if Apple continues to dip, even like 130, if it gets near my cost basis, I'll definitely load up. I mean, this is the best company, or let me rephrase that, one of the best companies in the world, and I can't believe it's being thrown out with all the others. So then the next one is Microsoft. I think, yeah, they were down 2.7%. They were almost near my cost basis of 241, which is amazing to me. I've been holding this for like a year and a half, and I can't believe that it's even getting close to where it was. I mean, if you think about it, it was near 340 just at the beginning of the year, which Oh my! I don't know how to describe the company. All companies are getting traded down, so it definitely gives you opportunities to pick up companies like Microsoft, Apple, and Waste Management if they get traded down anymore with people just selling out of ETFs and all that. So the next company we have is American States Water. So again, they were up 0.13%. This is one of my newer holdings, and as you can see, I'm up almost 3%. The I feel like I bought it at a really good time, um, and there's nothing really to say about this. This is just one of the companies I'm planning to hold for the rest of my life. So it would take a lot for me to sell. And then I'll get more into Costco, the newest addition into the portfolio. And as you can see, one other stock might be missing. I'll dive more into that. So Toro, um, they were down 4.5% this week. Again, they are really tied to the economy. So with retail going down, one of their, not the biggest, but one of the big customers is obviously the consumer buying a lawnmower for the yard and all that. If we're going to a recession, they might hold on to their lawnmower, like their old lawnmower, a little bit longer. So I feel like this is still a hold. I'm waiting. I jumped in a little bit too early here at 84. If it gets below 70, then that's when I definitely step in. Because right now I think their dividend yield is like 1.7. If it can get closer to 2, I feel like that's definitely a buy. Because this is a great company. I just need it to come down a little bit more. And then the next company, JP Morgan, they again they were down 1%, but they were up pretty big but with on the backs of like Target and Walmart's earnings, they came crashing down. Again, they're tied to the consumer and macro events, and if we're headed to recession, banks aren't really a good place to put your money. So I feel like that's why it's trading down a lot. But the next one we got is AO Smith. Uh, right, they're down 3% on the week. I feel like this one actually is a good time to initiate a position or accumulate some shares. This company is not going anywhere. It's water heaters and water filtration. Like if we're in a recession, people are gonna need their water heater. If it breaks, like replace it, or like safe drinking water. This I feel like isn't tied to the economy at all. Like if your water heater breaks, you're not gonna just not have hot water. This is one of the really safe one, and it's trading down like it's tied to the macro economy. Like as you can see, it's down nearly 20% in the last 3 months, and it pays a pretty good yield, about 2%. Low PE ratio. I feel like it's a good time to accumulate some shares. Lowe's, I forgot about Lowe's. Lowe's did report earnings this week, and they are down for almost 4.5%. I looked through the earnings report. I'll put a link to that video, and I wasn't alarmed by anything. They had a slight decrease in same store sales, nothing crazy, especially with the stimulus dollars of last year. People going out and renovating their kitchen and offices and all that. I wasn't too alarmed, especially only 3%. I think it's 3% decline. Nothing alarming. And then all the other stuff, they had growing earnings per share. They were buying back shares. They had net income. They're I was definitely, as a shareholder, definitely happy with the quarter, but obviously investors weren't too happy with it. I feel like this has more to do with the retail, and obviously Lowe's is retail trading down. But yeah, I feel like I was impressed with Lowe's quarter. I'm surprised it was down almost 5%. And then the next one we got is T Rowe. So they are essentially flat over the week, which I honestly expect this company to trade flat maybe for like a year. The like maybe getting to like 115 again and just trading sideways. Um, so with T Rowe being an asset manager, their fees that they charge on their assets is directly tied to the stock market. So if stock market goes down, their revenue goes down. So if you need the stock market to rebound essentially for this stock to rebound. So when the stock market's going well, as you can see, it has these huge upswings. But when it's going down, it really goes down. So I expected to trade sideways here. But at the meantime, I'm collecting a 4% dividend yield. This pays me about $80 a year. I'm well, I'm well happy to just sit here and accumulate that dividend income and wait for the stock to go up, and even accumulate some shares if it can dip below even lower. Because as you can see, my cost base is $137, and right now it's at $121. Definitely a good time to pick up. And then the last company we have is Disney. Disney had another bad week, about almost down 5%, 4.65%. This one's a tough one. It doesn't pay a dividend, so it's hard for me to justify buying it here because this is obviously a dividend growth channel. We want it, and but at the same time, I don't see how it could go any lower. It is priced in like Disney Plus is going to fail, never become profitable. Their parks are like not making money, but as you can see, like they reported earnings about 2 weeks ago. I'll link that video again, and their parks are more profitable than they were even pandemic. They have more revenue. This company's firing on all cylinders in the parks department. They just need Disney Plus to become profitable, and then investors, I feel like, will jump back into it. Right now they lost about $1 billion on Disney Plus. I think it is the last 12 months, but they're continuing to add subscribers. So as they add subscribers, the content spend will stay the same, and then that additional subscribers will start paying for that content and actually making Disney Plus profitable. And as you can see, sentiment was that Disney Plus would become profitable, and it was trading around 175. It consolidated there for about like 6 months, but now there's fears with a recession and all that, and it's just completely cratered all the way down to 102, which is amazing to me. But yeah, so that was the last company, and so let me jump into what I did this week. So I actually sold out of Domino's. It was I sold it at a loss of about $70. So which isn't crazy. I made about $900 off of Lockheed Martin selling that. So it's a way to tax loss harvest. Just decrease the taxes I owe at the end of the year. And then with those proceeds, I bought 1 share of Costco. But I kind of want to explain why I did that. So as you can see, Domino's is down 40% from its all-time high. And then after I saw it drop about 30%, this is where I started to pick up some shares. I bought it right around 400. But as you can see, it continued to go down. I thought this was kind of bottom. I saw it kind of consolidating near 400, so I bought it there. And don't get me wrong, Domino's is still a great company. They're growing earnings per share and all that. But with the market downturn, I feel like Costco is just a better business model, and especially if we're going to recession, like with food, like people are gonna, if gas prices are going up, they're gonna get a Costco membership to get that cheap gas. They're gonna buy foods in bulk because they're cheaper, and I just feel like it's a better business model for the long term and the short term. They'll definitely have a better time navigating these hard times of like a potential recession. And then they were also thrown out, like they were trading down. So yeah, in the last 5 days, they're down 16%. They're being thrown out like they have the same struggles of a normal retailer, but I assure you they definitely don't. But with another reason I sold out Domino's, so their same store sales growth was for the US was negative 3.6%, while Costco's in the last 12 weeks was up 16% year over year, which it just shows the strength of Costco. But at the same time, you're paying a really high PE ratio for Costco. It's nearly 33% higher than the S&P 500. And if you're not familiar, a PE ratio is just your earnings per share divided by the price. So the 31 is, so if you took 31 times their earnings, that would equal $416. That is just another way to look at it. And so they had declining same-store sales growth. But one thing I love, at Target and Walmart, they were struggling because the profitability of their stores was going down, and they weren't making as much on the products they were selling. But Costco, so they essentially run their stores and like merchandise at a break even. So Last year they made 51 billion, or the revenue was $51 billion, but their total cost were nearly 50 billion in selling that. So as you can see, they make about 900 million off just the food that they sell and all the products, but they make another 900 million just off membership fees. It's a reoccurring revenue, and it just, this 967 million flows straight to the bottom line. So as you can see, they made 1.8 billion in the last 12 weeks, and that 900 million flowed straight to the bottom line. And that's what I love. 50% of their earnings is just reoccurring revenue. No one, Costco's memberships are some of the lowest like churn that they're out there. If once you're into Costco, you're not canceling the membership. So these memberships are very resilient in a recession, and I feel like they're going to grow with gas prices going up and all that. And like I said, they run their stores basically at a break even. They make about $1 billion off 50 billion, so about like 2% margins, nothing crazy. But yeah, this is why I bought into it. This was subscription revenue. In a recession, people that aren't going to cancel their Costco membership, so they have a more resilient form of revenue, and then that revenue of the memberships flow straight to the bottom line, which I love. And another reason I sold out of Domino's is I find it here, is their debt. So Costco actually has 12 billion in cash and only 9 billion in debt. So they have $3 billion of cash actually left over. But Domino's is a completely different picture. They have 164 million in cash, but their long-term debt is 5 billion. I definitely don't like the sound of that, especially their market cap is 17 billion. So their total long-term debt to total capital is nearly 500%, which is one of the highest I've seen in the entire stock market, while Costco's is 30%. So if you take the total capital that Domino's has, they have 5 times more debt than that. But if you take Costco, they actually have like 0.3 times their total capital. That's just another way to look at it. I definitely feel like it was a good time to just sell out of Domino's at a loss. You're not married to a company. That's what a lot of people think. If your thesis changes on a company, you have no problem selling it. Move it to a company you have a higher conviction on, and that you feel proud to be a shareholder owning it for the future. And I definitely feel like that's Costco. I feel like they have one of the best business models in the world with that subscription revenue, and they're being thrown out with retail because of on the backs of Target and Walmart having a terrible quarter, and I don't think that's right. And so to wrap up this video, I know it's kind of a longer one. Let me hop in here to just show you my watch list. So these are the 5 companies that I'm looking out for this week. Intel is getting to a point where if it dips below 40, I feel like it would be stupid to not step in. It is just insanely cheap right now, and they pay you a really good dividend yield just to be patient while they build out these foundries and stuff. Nike, again, this is one of the best companies in the world. It's not going anywhere. If it dips below 100, definitely think about buying. Starbucks, this is a tough one. I don't ever shop at Starbucks, and with the recession, people are going to cut back on coffee, but it's getting traded down and thrown out with the rest of the market. I feel like getting it below like 68 or whatever is a good time to buy. Texas Instruments, actually, I think like is still overpriced. It needs to get below at least 155 before I pick it up. But again, this is one of my favorite companies. They have an amazing balance sheet and just an overall great company. And Union Pacific, this used to trade at like $270. It's been thrown out, especially with the concerns of a recession. But 213, if it gets below 200, I feel like it's stupid not to step in. It's an amazing company. They pay about 2.5% dividend yield. It's very consistent revenue, and yeah. So if you guys like this content, make sure to subscribe and like, and I'll catch you in the next one. Peace.